My name is Dusty Rollins, and I have a company called Oxford Business Services, and we are a tax planning and wealth strategy business. I have that little bit of an outsider view, and so I'm a business owner. I've been a business owner my whole career. I'm thoroughly unemployable. That perspective as a business owner has led me looking into and becoming an expert on tax planning and tax strategies and wealth building, but from the business owner's perspective, not just a CPA. You know, I find a lot of people, their CPA just does the tax prep and kind of puts numbers in boxes, and then, you know, I like to say, what are you doing? What are you wanting to do? And then figure out ways we can accomplish that. And in many respects, kind of working with what the IRS and the government want you to do.
Why is it so important for small business owners and entrepreneurs to focus on their taxes?
The IRS has gotten some massive funding for their business. And so they're going to more than triple the agents that are out there auditing. And so what I'm telling all of my clients and prospective clients, I'm saying, look, you need to always do things right, but now you really do, because your audit chance is going up. And it's not to scare anybody, because if you're doing things correctly and it's all set up, then an audit is just a hassle. You know, it's not a problem. But all those strategies you did that you didn't do just right and that you kind of skirted, those could come back to haunt you. So that's why I say it's even more important now, because of the political winds and the governments. They're looking for money, they're looking for different ways to find that and to get it. And so business owners are a big target.
A large majority of our audience is in real estate investing. So can you tell us a little bit more about cost segregation and how that relates?
Sure. First, real estate is a wonderful tax space. So the government has deemed real estate an important area, and so they've given a lot of tax breaks. So getting into real estate investing is a really, really good tax play, in my opinion. A lot of properties will have positive cash flow coming into your pocket each month, and then at the end of the year, a negative number you're allowed to write off more than the cash that came in from the depreciation. So therefore, you're making this money and your tax bill is very, very low. Cost segregation, what that does is, say you have a building, it depreciates the entire building for the same period of time, which is 20 or over 30 years in some cases. Cost segregation, you do a study, you have to hire someone to do it. Technically, you can do it on your own. I just would not. But you can hire somebody to do the study for you, and they take the parts that break down quicker, right? So if you have a piece of property, the dirt doesn't depreciate, it's not going anywhere, it's not losing value, but the parts of the building, your roof, it's not going to last forever, your air conditioning, your electrical. So the cost segregation takes those pieces of your building that are going to depreciate quicker than that long period and allow you to put it into 5 or 7 years. So it massively increases the write-offs you get on those properties.
How do the business entities and the entity types affect your taxes?
It's a great question. One of the most important things, and one of the areas I see people get wrong a lot, is the entities. So the entities, and anyone that's done any research into real estate investing will have heard about entities, because you can make a lot of money selling courses on how to set up entities. The entities are where the legal and the tax part kind of merge, right? So you can you need to set it up properly for asset protection. And so one of the key parts is, you know, so you've got LLCs, which a lot of people, I'm not an attorney, a lot of people like for real estate, but you have to set them up and you have to run them correctly. That's where I see the biggest mistake. I've seen this nightmare many times. They have all of these entities, and the second you get sued and you go to court or arbitration or whatever, you know, when the attorneys get involved, they can easily say, wait a minute, yes, you set up this LLC, but you didn't run it right. So we're going to disregard that. And then all of the pre-work you did is thrown out the window because you didn't do some simple bookkeeping and record keeping.
And can you tell us a little more about solo 401ks and self-directed IRAs?
If you have no employees in your business, you're the only employee, or you or a spouse, you can set up a solo 401k. And with that, you can actually run a traditional 401k, which means you get a tax deferral on your contribution. You know, so you put money in, and that's less money you have to pay income tax on that year. Or you can do a solo 401k Roth, which means you put in after-tax dollars, but the money grows tax-free. Or then on the self-directed side, you can set up self-directed IRAs, SEP IRAs that are all in this umbrella. And what that is doing, the self-directed part and the solo 401k part, means you can take that money, which a lot of employees can't. So a traditional 401k, at GE or some giant company, that employee can't just go start investing in fix up real estate or buy and hold real estate, whatever you're doing. The IRS has not heavily regulated these, in my opinion, these structures and these entities. And I think they're going to start. This is where just a little extra attention to the setup and the upkeep and maintenance of it, or pay somebody a little bit of money to do it, can help prevent huge problems down the road.
And along those same lines of setting it up properly and running it properly, how important is it to keep good books and records?
AI and technology advancements are rapidly coming, and investors and business owners need to take advantage of it so that you can keep your books much more simply, but then keep them accurately. And I've dealt with numerous audits with the IRS, and many times we would have a very strong case, but we couldn't prove, because of bad records and bad bookkeeping, we couldn't prove that this expense went to here, or this, we could not prove the data. And so it got denied as a write-off just because we couldn't accurately prove. And so had that just been properly classified and properly recorded, it would have been fine.
Alrighty, and then you did give me a little teaser before we started recording here about a secret of what the really rich do. So can you tell us what that would be?
So one of the things that's interesting in the tax code, there's kind of two sections. One is income tax, and that's what generally 99% of the US population knows about. Well, there's this other side called capital gains. And capital gains is what the taxes you pay when an asset goes up. But capital gains is where the really rich people have their money. And so the strategy, when you look at what do rich families, and I'm talking about generationally rich, the tax code, the income tax code only started in 1913. And you see a lot of real estate investors particularly, right? They think the only way they can make money is, well, I got to buy an asset and flip it right away. That's a short-term flip. Or I buy it and hold it for a while, and then when it goes back up in value, I'll sell then. When you look at these rich families, I'm talking really rich families, you'll look and they'll say, well, my great-grandfather bought a block of Manhattan and we own it today.